this is a lower start this Monday. Our market master of the day is with us. Nilesh Shah is Managing Director at Kotak Mahindra Asset Management Company. He is joining us to take some questions. Nilesh, it's always a pleasure having you with us here on the program. Thanks very much. Your thoughts, Nilesh, after the run-up that we've had and, slight pullback that we are now witnessing, just day two in terms of that.
I think now the market has to take a little bit of respite and even correct a little bit. This will be driven by a variety of factors. One, the recently concluded quarterly earnings for June 22 quarter, that's marginally below expectation, driven mainly by some large stocks, and overall breadth of the earnings has been positive. So clearly, market has discounted breadth of the earning, but it probably has to discount some disappointments in larger names driven in automobile or in oil marketing companies. Second, globally, scenario doesn't look that good. There is a meeting at Jackson Hole where US Fed and other central bankers may try to be hawkish. That will weigh on the mind of the market. So we are at a stage where there is a need for consolidation, and the next move of the market will be dependent upon whether global uncertainty starts receding or starts increasing.
Nilesh Bhai, good morning. What's very interesting is that we needed almost about 20% of FI outflows. I mean, which has taken market almost back to highs. It's only this month there's been 18,000 crores of buying. I think selling was 10 times of this. So what does that tell you about the texture of the market and the retail flows? I know you're smiling because that's been one of your views. But overall, the texture of the market from the multi-year bull market point of view, what does that tell you?
I think there is far more confidence on India growth story because we are standing out like an oasis in the desert. Our inflation is lower than many of the global inflation averages. Our growth is higher than many of the global peers. More importantly, I think India offers a unique combination of growth. Our earnings growth are likely to be superior to our peers. Second, governance. Our corporate governance standards are far better than many of our peers. And third, returns which are green, as we are more conscious about environmental and social impact. This combination of 3G, growth, governance, and green becomes a very, very tempting offer for investors, be it local or be it global. The only concern right now is that our valuation continues to remain above historical averages vis-a-vis our peer group. We have always traded at a premium, but today the premium is higher than our historical average. Are we factoring in lots of good news? I hope and pray that others' valuation starts improving and hence the gap narrows rather than our valuation coming down.
Good way to put it, right? Let everyone grow instead of being jealous of someone else's growth. The market, by the way, Sonia, right now is seeing a sharp decline. The bank nifty is now down 540 points. Kotak is leading it, of course, but Axis as well is now participating along with ICICI Bank. So just keep an eye on the screen because from the recent highs now, it's almost 400 points gone on the Nifty.
It is, yeah. So there's clearly a wave of profit taking, right? I mean, something that perhaps the street was expecting for a while. Nilesh, hi, good morning. I remember very clearly 4 or 5 weeks ago when we spoke to you, you said that this is, a big bull run that we're looking at. And look at the market. I mean, it's up, about 11-12% just in the last 2 months. Do you think that even if someone has perhaps missed out on this rally, right, there is this FOMO feeling that you get, people are still not ready to believe because there are so many macro issues still that exist, whether it's inflation, whether it's an impending recession. If someone has missed out on this rally, do you think one should jump in now, or do you think that you can just wait a bit, perhaps you'll get better levels?
So Sonia, it's always difficult to predict market. And my recommendation is please do systematic transfer plan. Use every correction as an opportunity to invest. if you have X amount to invest based on your asset allocation, divide that into 12 installments to be invested over next 6 months or 12 fortnights. And whenever you see a correction like today, start investing. So instead of waiting for market correction, catch the bull by the horn, trying to split your money to get invested during correction phase.
Okay. So, all right. So, of course, the systematic investment plan is something that, one should continue doing and should not stop irrespective of which way the markets are headed. But suppose one has a chunk of money that wants to invest right now in this phase. What are the sectors? Is it like a top-down market or is it a bottom-up approach that one should look at? And any sectoral biases that you have? For example, if one had invested in autos about 8 months ago, you would have made great returns up until now. Is there any big theme that you're looking at for the rest of the year?
So you'll have to invest on a bottom-up basis in a market like today. We have seen some of the large corporate names disappointing on results. But overall, 14 out of 20 sectors which we track at some level, they have given earnings which is better than or in line with expectations. So this time we are seeing breadth of the market giving decent earnings in line or ahead of expectations, but certain big names disappointing. Now, in this scenario, you have to be bottom up. From a sectoral point of view, at Kotak Mutual Fund, we have been bullish on capital goods and industrials. We believe these companies now have started receiving orders not only from government, but also from private sector as capacity utilization has started crossing pre-COVID level, and also from exports market. The China plus one theme is working out in industrial and capital goods. Some of the multinational companies are probably looking at blistering pace of growth as they shift their sourcing from China to India. So overall, industrial and capital goods is one sector where we believe there will be great opportunity in the years to come. The second sector where we have been bullish and which is correcting today is banking. There is a consolidation in banking sector. Your deposits or your loans are likely to be from 5 to 6 banks. Second, NPAs are fully provided for. This time, our banking and financial system is fairly solid. And finally, as rates have increased, their margins are likely to improve as they have taken the hit on the treasury side. Put all these things in combination, banking and financial services along with industrial and capital goods appears to be outperformer in the market.
Nilesh, the point about industrials and capital goods, China plus one, the broader theme seems to be manufacturing exports, right? I mean, that's the broader umbrella kind of thing.
Yeah. We have an advantage of all the three things because now all the three customers are firing. Government was earlier giving orders and their tax revenues are fairly solid. They are sitting on 3 to 4 lakh crore of cash to spend. The private sector capex has revived in renewable energy, in commodities, and exports market has opened up. So industrial and capital goods are likely to be firing in all the three engines.
What about areas like high quality companies in textiles and outside of this, where the theme is the same, which is manufacturing exports? And is there a product one can kind of invest in? I mean, I don't know. I mean, to kind of get exposure to this in one shot?
So, thank you for asking me this question. We had actually launched a product called Kotak Manufacturing Fund, purely on the theme of renaissance in manufacturing. Obviously, investor has to read the offer document and then take a decision in consultation with the distributor or advisor. But we remain fairly bullish on manufacturing theme. We think like what we did in IT services and generic pharma and two-wheeler automobiles, we are likely to repeat that in many other sectors like technical fibers, like electrics and electronic components, like auto components. So manufacturing will be seeing a kind of renaissance, what we saw in IT sector or generic pharma sector or chemical sector. And this is one fund which one should consider in consultation with the distributor or advisor.
Okay, Nilesh, since you spoke about IT and generic pharma, and they have done really, great for us as a country, right? In terms of having our balance of payment issue sorted and the currency issue sorted. But stock-wise, especially pharma, it's not doing at all. In fact, it's been underperforming in a rising market, in a falling market, and even IT as well. There are question marks now on whether these stocks need to correct now because of the kind of valuation that they trade at. Your thoughts on both these?
So Anuj bhai, as you correctly mentioned, there's nothing wrong with the business per se in IT or technology sector, but valuations were way ahead of their fundamentals with the benefit of hindsight. Rarely we have seen mid-cap ITs trading above large-cap ITs valuation. Rarely we have seen large-cap ITs trading at this high valuation. Now probably prices are correcting or stabilizing so that fundamentals can catch up with them. There is undoubtedly uncertainty on global macro. Will companies continue to spend on technology? Will companies cut their budget on technology? That question mark remains, but undoubtedly from a business point of view, IT sector is doing well. It is the valuation which needs to get in line with the fundamentals. On the pharma side, unfortunately, we have seen a couple of disappointments. The expenditure on research or on sales and distribution has not been proportionate to the growth. The price drop in generic pharma in US and other markets has been fairly steep. And clearly in pharma sector, from a business point of view, delivery has been subdued, and that is reflected into those prices. In technology, valuations have to adjust. In pharma, even business have to deliver so that valuations can be justified.
Just one final question. I know we briefly discussed this, but wanted your thoughts on what one should do with the auto names now, because most of these stocks have seen a 30-40% gain this year already, whether it's M&M, Eicher Motors, TVS, etc. And there is a flurry of new launches in the market. There's so much work for auto companies, auto ancillary manufacturers. Do you think this is the start of a structural uptrend in this space?
So in the auto sector, one big risk which continues to remain is if something happens to Taiwan. That's the global hub for manufacturing of semiconductor and chips. And if anything goes wrong over there, we will see the repeat of the cycle where chips are in short supply and automobile companies are not able to fulfill orders because of the raw material shortages. Subject to that limitation, we believe auto stocks have a very decent pullback. Their order books are fairly steady. The demand for motor cars and commercial vehicle has been strong. Two-wheelers has been subdued. So if you're looking to build a portfolio in automobile sector, my recommendation right now will be to go a little bit overweight on auto components rather than automobile manufacturers. Within automobiles, focus on commercial vehicles and motor passenger vehicles rather than two-wheelers.
Okay, Nilesh, we'll leave it there today. Thanks a lot for joining us. It's always good talking to you about all things market. Let's move on then. Balrampur Chini is the stock in focus. It posted a very weak set of